Opendoor Technologies, ticker OPN, is currently trading at $7.29, and it is having a very rough session, down about 36 cents or 4.71% on the day. Today's volume is already massive, with over 57.5 million shares changing hands as the stock bounces between a low of $7.11 and a high of $7.61. This is a stock that lives on volatility, with a 52-week range that stretches from a terrifying 51 cents to a high of $10.87. Now, looking at this intraday drop, most investors might assume this is just the market pricing in the next set of bad news for the real estate sector, or perhaps just profit-taking after a huge run-up from its lows. But the real story today, the insight that is flying under the radar, has nothing to do with today's price action and everything to do with a press release that just hit the wire. Opendoor announced this morning that it is completely changing its upcoming earnings call on November 6th. It's calling it a financial open house, and it will be one of the very first companies to live stream its results directly on the Robinhood platform, taking questions from retail investors. This is an explicit, calculated, and brilliant move by management to bypass Wall Street analysts and speak directly to its true shareholder base, which, as filings show, is nearly 45% retail investors. This isn't just a gimmick. It's a statement. It's management recognizing who owns the company and facing them head-on, just days before a pivotal earnings report. The common expectation for Opendoor has always been a simple binary bet. You either believe it's a technology company, a true e-commerce platform poised to disrupt the ancient $2.2 trillion residential real estate market, or you believe the counter-narrative, that it's a high-tech coat of paint on a very old, very dumb business model, a leveraged house flipper burning billions in cash and completely at the mercy of macroeconomic forces it cannot control, namely interest rates and home prices. For the past 2 years, as the Federal Reserve hiked rates at a historic pace, the second narrative, the bear case, has looked like the undeniable reality. The stock collapsed from its post-SPAC highs, and the company's survival was openly questioned. But the deeper reality, the one the market is struggling to price in, is that both the company and the environment are in the middle of a profound shift. The macro environment, the primary headwind, is finally easing. The Fed just cut interest rates by 25 basis points yesterday, its fifth cut since the peak, and the average 30-year fixed mortgage rate has fallen to 6.19%. This is providing the first real oxygen to a housing market that has been suffocating. Simultaneously, the company itself is attempting a massive pivot, shifting from its capital-intensive iBuying model to a distributed platform using partner agents, a capital-light strategy that it claims is already boosting conversions. This pivot is happening just as the stock has become one of the most intense battlegrounds on Wall Street. The pressure from short sellers on Opendoor is immense and cannot be overstated. As of the most recent data from mid-October, there are 161.12 million shares held short. That is a staggering 27.4% of the company's entire float. This isn't a minor bet against the company. It's an all-out assault from a massive contingent of the market that is betting on failure. The short thesis is clear and compelling. They believe the company's balance sheet is fragile, that its pricing algorithms cannot handle a volatile or declining housing market, and that the positive adjusted EBITDA of $23 million it posted in the second quarter was a one-time fluke, not a trend. They are looking at the consensus estimates for the November 6th earnings, which project a 38.2% year-over-year decline in revenue, and they are betting that the company will miss these already lowered expectations and burn through more cash than anticipated. They see a company that is fundamentally a real estate flipper, not a tech company, and they believe its margins will be crushed as it's forced to sell its current inventory in a weak market. But here is where the reality for investors gets more complex and where you need to look deeper than just that headline short interest number. What's your take on that 27% short interest? Is it smart money pricing in a Q3 miss, or is it a massive trap? The fascinating part is the cost to short the stock. The short borrow fee rate is currently sitting at a very low 0.76%. This is not the double or triple-digit borrow rate you see in a panicked high-demand short squeeze. This low rate suggests that while short interest is high, it is not difficult or expensive to get shares too short. Large institutions are likely more than happy to lend their shares to short sellers, collecting a small fee while betting against the stock themselves. This is further evidenced by the institutional filings from mid-year, which showed a stark divergence. Legacy institutions like Vanguard and BlackRock dumped tens of millions of shares, with BlackRock alone reducing its position by 70%. They are out. But at the same time, quant-driven funds like Two Sigma Advisors and Cube Research loaded up, buying millions of shares and opening new positions. This isn't a simple retail versus hedge fund fight. It's a war between different factions of smart money, with retail investors caught in the middle. For the average investor, this is what you need to know. You can track short interest data directly on the NASDAQ website, but the more critical metric to watch daily is that borrow fee rate. If you see that 0.76% rate suddenly spike to 5, 10, or 20%, it's a signal that shares are becoming scarce and the shorts are beginning to feel the pressure. The days to cover is currently less than 1 day because of the stock's massive trading volume, meaning shorts can exit their positions quickly. This isn't a setup for a slow, protracted squeeze. It's a powder cage for daily volatility. This entire setup, the massive retail base, the institutional exodus, the quant fund influx, and the heavy short seller attack, perfectly explains Opendoor's surprise announcement today. Management knows that institutions like BlackRock have abandoned them. They know that analysts on Wall Street are largely skeptical. So they are appealing directly to their 45% retail ownership base by going on Robinhood. It's a move to control their own narrative, to answer questions from Main Street instead of Wall Street, and to build a base of support ahead of what will be a brutal earnings report, at least on the revenue line. The company's future no longer hinges on the original iBuying model. That model, which involves Opendoor buying a home with its own cash, doing light repairs, and reselling it for a fee and, ideally, appreciation, is simply too dangerous and capital-intensive in a volatile market. The entire long-term bull case now rests on the success of its new capital-light platform. This new model aims to be more of a marketplace, connecting sellers with partner agents and giving them multiple options: the traditional Opendoor cash offer, a standard listing with an agent, or a hybrid product. The company claims this pivot has already doubled the rate of customers reaching a final underwritten cash offer. The question is whether this new model can generate meaningful, high-margin revenue fast enough to offset the cash burn from the legacy iBuying business. Looking forward, the tension between expectation and reality will come to a head on November 6th. The catalysts for the stock are clear. First, the macro environment. If the Fed continues to cut rates and mortgage rates fall definitively below 6%, the entire housing sector will get a lift and Opendoor's core business becomes viable again. Second, earnings. If Opendoor beats the low consensus EPS estimate of a 9-cent loss, or if it shows a sequential improvement in its contribution margin, that would be a huge win. But the most important thing will be guidance. If management provides any credible data showing that the new agent platform model is scaling profitably, it could force a complete re-rating of the stock and trigger a massive short-covering rally. Comment below if you plan on tuning in to that Robinhood financial open house on November 6th. The risks, however, are just as stark. A miss on earnings, or worse, weak guidance, would confirm the entire short thesis. If the company reveals that its inventory is stuck and it will have to sell at a significant loss in the fourth quarter, the stock will be punished. If the new capital light model is shown to be a costly distraction, there will be little left to support the bull case. In the end, Opendoor remains one of the purest expressions of the expectation versus reality dynamic in the entire market. The expectation is that you are buying a technology disruptor. The reality is that you are for now buying a highly leveraged real estate company that is in a race against time. It is racing to pivot its business model before its cash reserves run low while fighting a two-front war against a weak housing market and a 161 million share short position. The company's decision to embrace its retail shareholders on Robinhood is